Welcome back to this very special Indianomics, which is coming to you from the sidelines of the JP Morgan Summit. I have been speaking with Jahangir Aziz, the Chief Economist, Emerging Markets for JP Morgan, and Luis Ogares, the Head of Currencies and Commodities Research for JP Morgan for Emerging Markets. So absolutely the two appropriate people we have to hear out. Jahangir, Luis, thank you very much for your patience. Jahangir, now let me come to the India growth story. We are very pleased with the fact that 6 to 6.5% growth is being delivered at a time when the world is not very clement. And now you have this added comfort of some $25 billion, which will come to us from the bond index investors at a time when the dollar is going to strengthen. But we don't have to worry because there is at least capital flow. What's your sense? Can this also improve growth because of the comfort on macros?
You tell me what the RBI will do, I will tell you whether or not growth improves.
You have to tell me both.
If you look at the last 10 years of playbook of the RBI most likely is going to intervene every dollar that comes into because of the bond flow. Whether it is the money that's going to come to front run the inclusion, which will probably happen in the middle of next year, or whether there's an actual inflow from dedicated real money investors already coming in, most likely the RBI is going to intervene everything that comes in. That is going to, let's say, I'll take your number, 25 billion. 25 billion into 82 is going to inject a significant amount of liquidity.
1.7 lakh crore was what I was
will be in the interbank market. In this day and age, with inflation where it is, the RBI cannot afford the interbank rate to go below the reverse repo rate, which means that the RBI is going to offset the entire 1.17 lakh crores by either selling bonds or by not buying the extra amount of bonds that it usually does in every year. I don't think that the RBI, given where India stands, will want anything to disturb what it believes to be the right interest rate differential with the treasuries. I don't think it wants to do anything to topple what it believes to be the right dollar INR or dollar INR CNY rate or inflation or reverse or interbank rate for something that might happen in a year from now and take 10 more months to get fulfilled. Yes. So right now my guess is that everything has intervened on both sides, both on the INR side as well as on the bond side. So the net impact, maybe a little bit that might happen between the INR intervention and the bond intervention.
Let me not pin my question too much on the flows from bond investors. My more general question is on growth.
Yes.
Are you seeing enough reasons to be optimistic that we will be able to go from 6.5% to 7% in coming years?
No, that we are not. But we are optimistic, along with India, the other emerging market countries, ex-China, that despite the fact that the biggest anchor of emerging market growth, which used to be China, actually languishing, emerging market has delivered this year every passing data point, and it doesn't matter which country you look at. He and I look at Brazil. Brazil, we started off the year by saying is going to be in complete recession. Every data point we have upped, including last week, we have upped Brazil growth. So I think that the emerging markets are showing significant amount of resilience. India is part of that. It is showing significant amount of resilience. And it is not just resilience on the growth front. It is also resilience, not resilience, but discipline on the fiscal front, discipline on the monetary policy front. And therefore, you're seeing much smaller current account, which is the Achilles heel of emerging markets at this point in time.
Yes.
So I don't think it's going to go from 6 to 7, but I think that the slowdown that we were fearing, I think you are going to continue to surprise us, both India and the rest of emerging markets, on the upside. And what you really want, and I know this, you won't like the answer, you really want these economies to slow down. If these economies do not slow down, then inflation does not get back to the zones, to the target zone. And whether you're talking about the Fed or the RBI or ECB, they will remain in play. you really do not want the central banks to come back rehiking rates. So you really want these economies to slow down. I think the slowdown needs to be non-disruptive. So far, the slowdown has been non-disruptive. In fact, the slowdown has been, surprising upside. But that's what we really want, a non-disruptive slowdown so that we can get inflation back to where we can say, okay, fine, the central banks are okay. They're not going to come back.
Okay. Well, at the moment, at least they're not in hiking mood, though they are tightening liquidity
Yes,
for exactly
absolutely.
the same fear.
Exactly.
But we are getting a lot of help from commodities. Louis, on that, we discussed crude. But is there a general other commodities disinflation that you will forecast for the next 12 months?
Actually, when you look at the projections that we have for base metals, for gold, for natural gas, even most agricultural commodities, although the picture there is quite varied, we have, we are down from the peaks, and a lot of that is predicated on, global, deceleration of growth, particularly China, who for base metals, as you know, is more than 50% of the demand. But if the projections for 2024 are, generally speaking, higher than the average for 2023. Why is that? Well, many reasons for different commodities. For base metals, a lot of that is actually, the demand that is going to be coming from the decarbonization efforts, right? The world trying to, rely a lot more on electric vehicles, and that demands a lot more copper, a lot more other.
But that's not showing up right now.
It's not showing right now, but it will, right? Why? Because there has not been in recent years sufficient investment for more production, right? Partly, so there's no, again, we all wish there was a switch to cheaper or cleaner energy without getting more dirty, inputs into the mix, right? So we will see, higher prices for base metals. You already made
By
some
when
reference.
By when do you? Because at the moment it seems to be a little lower than last month.
Yeah.
Copper and zinc and even ferrous.
Yes.
Slightly lower than last month.
So we think that the inflection point is actually going to happen in this second half of the year, and we're going to start to see prices starting to creep up higher already by the end of this year, and certainly higher during the course of 2024, which is interesting. Then we have, this is for base metals. For gold, gold, you would think that in this type of environment, probably prices should be more depressed, but gold is being held by, very different drivers. Some of them are actually geopolitical. Some of them are sanctions-driven, sanction fears. So things that before were not in the mix, right? And then when we get to agricultural commodities, we have this looming risk related to El Nino, which, it's a cyclical climatic regularity. Every 7 years we have an El Nino, which is going to push the soft commodity prices higher because it does disrupt, droughts in some places, floods in others, right? So generally speaking, I think the commodities complex is going to be generally supportive for the exporters, but of course, for some countries that are importing commodities, it'll hurt.
Okay, so this core inflation comfort is not something you're given as more comfort. We can't take it for granted. Jahangir, now for the last two questions to both of you. On the red flags, we have not seen such a rapid pace of rate hikes, and if Jamie Dimon's forecast was even partly correct, and we go in the 10-year towards 5.5 or something, what would be the red flags? Can you see some EMs fall, and I'll ask you that? Or can you see, just like we saw regional banks, is there any red flags that might lead to a financial problem for financial markets?
Look, I think in the US, I'm guessing your question is about the US. In the US, let's take the most sensitive, interest-sensitive item, which is mortgages. So mortgages now is about 730, 740, but no one pays 730, 740. If you look at the maturity-weighted mortgage payment, is around 4.2. It was at 3.5 and went 4.2. You need those to roll over at these current rates for people to feel the kind of pain that will require balance sheet adjustment. Go back into the corporate sector. A significant number of corporates, particularly in the commercial real estate sector, in the second half of 2020, when the pandemic completely crushed their business models, refinanced at close to zero interest rate for 3 to 5 years' time. That is coming to an end now. So far, they haven't felt the pain. So I think the pain will be felt. You don't even require rates to go higher if the rates just stay where they are for longer, without easing inside. These rollovers are going to keep debt service up, interest costs up. So I think that itself is going to start squeezing on the economy. But in terms of red flags, I think people have looked at what has happened to their mark-to-market books, etc., in the financial sector, and have already taken actions against that. The Fed came back with a significant amount of support, and to its credit, that entire regional banking crisis did not spread. Right. So I think there are risks, but I think the risks are more in terms of what this does to corporate balance sheets, in terms of actual profitability, and to what extent that creates the next phase, brings the expansion to an end, rather than are there large financial sector weaknesses that we should be worried about.
I'm told I'm out of time. Thank you very much, gentlemen, for your analysis of emerging markets. We're going back with the view that growth in emerging markets is better than expected,
Yep.
but this core inflation fall that we thought is a positive may not be there for long. We have to wait and watch. Thank you very much
Thanks,
for this
Leila.
very special edition of Economics, and thank you all for watching.